Hello and a warm welcome. You've joined us on ET Now. I'm Ashesha Advaryu, and first up, let's take a look at what the markets are doing at this point in time. Nifty, that one is sitting with a cut of nearly 26 points as we speak, and we have recovered significantly from the lowest point of the day, and we are still sustaining about that 26,150 mark. Nifty Bank, meanwhile, continues to underperform. It has shed nearly 225 points as we speak. But let's put the spotlight on a company, EPAC Prefab Technologies. That one has entered into an MOU with a global company to expand its capacities. What is the MOU all about, and what is the outlook going forward when it comes to company's capacity expansion plans? To discuss this, we now have the MD and CEO of EPAC Prefab Technologies, Mr. Sanjay Singhania, now joining us. Mr. Singhania, afternoon, and thank you so much for joining us here on ET Now. And first up, let's talk about this MOU itself that you've signed with a global company. And this, I believe, is to facilitate proposed capacity addition that has been planned by you and is intended to be undertaken in the state of Gujarat in collaboration with the global company. Tell us, what is this all about? How will it help your capacity expansion and growth plans?
We have entered into an agreement with Masket for the purchase of a land parcel of around 39 acres. So in this 39 acres, the plant will be located in Vitlapur near Ahmedabad, and it will be catering to the markets of Gujarat and Maharashtra for us. The plant would be for like structural steel fabrication. So EPAC Prefab would be investing close to 200 crores in this plant, and the installed capacity will be around 84,000 tons. And post this installation, the total capacity of the company in structural steel will go up from around 1,70,000 tons to 2,54,000 tons.
All right, and let's also discuss more on this MOU that you've signed. You've proposed a total investment of about 100 crores for this. How do you aim to fund this investment?
So actually, like in the first phase, we are doing an investment of around 120 crores. So, like it will be funded from internal accruals, like internal accruals, as well as, like the fund is already available with the company. So when we raised the fund through IPO, we raised around 160 crores that we are deploying in putting up a brownfield expansion in Andhra Pradesh and a greenfield expansion in Gilot, Rajasthan. But besides this, like before the IPO, also we had a FD of close to 145 crores. So that FD is still with us. The fund is still with us, and this fund would be deployed towards the ramping up of capacity for structural steel fabrication in Gujarat.
Understood. So that's as far as the latest MOU is concerned. But Mr. Singhania, let's also talk about your order book, because last time when we interacted with you on the 24th of October, you did tell us that your pending order book at that time was at about 920 odd crores. Where does it stand now, and what is the visibility around new order wins and new demand that is shaping up in the market in the second half of the year?
So, in our business, order book is of paramount importance because it gives a clear visibility. And for us, the visibility is around 8 months for us. Traditionally, it has been that way. Our order book to revenue ratio is around 1.5 times. And right now, the order book with the company is around 1,100 crores. So it means, in the next 6 to 8 months, the company would be able to do a revenue of close to 1,200 crores.
Understood. So that's the target when it comes to demand and order book going forward. But is there a target that you're working with when it comes to book to bill ratio? What has been the execution timeline been, and how much of your order book now is coming from new orders?
So this plant, which would be setting up, so the idea is to make it operational by September, October next year. And when you talk of the new orders coming in, right now for us the strongest market is South. We are getting a lot of orders from the southern zone, but like this Gujarat and Maharashtra, they have most number of factories coming in. So it means the opportunities are huge for us. And that is one large market in which our manufacturing presence was not there. So we were not able to, book big orders. But with this presence, I think, we will be able to dominate the entire market as well.
Since you're very bullish and you're telling us that you will be able to dominate the entire market, is 25% top line growth possible over the next 3 years? Is that the aim that you're working with?
Definitely, yes. We have guided the market that this financial year we would be doing a revenue growth of close to 33-34%, and we still maintain our guidance. I think in the first half of this year, we have exceeded that expectations of the market. And full year wise, we have given a guidance of close to 1500 to 1550 crores. So we are very, very confident of achieving that number. And not only this year, for the next year also, with the kind of momentum we see in the order book, with the kind of momentum we see in the upliftment and the delivery of the material as well as the execution at the site level, which we are able to do. I'm very confident that next year also we should be able to do at least 25% kind of a revenue growth for sure.
And what is the outlook when it comes to your margins? Are they sustainable going forward as well? And also wanted your thoughts on competition. Are you facing heightened competition which could perhaps weigh heavy on pricing and consequently margins going forward?
Yeah, on the margin front, our guidance is always that it will be range bound between 10.5 to 11.5%. So it is our endeavor to maintain this margin. Although in the H1 of this financial year, the margin was 11.5, but our guidance is 10.5 to 11.5. We feel that this is a sustainable margin for us in our business.
Okay, so 10.5 to 11.5%, that's the sustainable margin guidance going forward. But Mr. Singhania, let's also talk about your debt profile. Do you maintain your stance of becoming net debt negative by the end of this fiscal? And what do you aim to do with the 500 crore cash balance that you're sitting with? Do you aim to deleverage further because you're sitting with the cash balance?
See, we had a total debt of around 210 crores when we went public, out of which around 145 crores were already with us in terms of FD. So it means around 55 crores was a kind of a debt in the company. And post IPO, with the IPO money which we raised, we have paid a debt of around 70 crores from this. So it means already we are debt negative, and we continue to generate good cash flows. In the last 6 months, we have generated over 88 to 90 crores in their positive cash flows. So this is business is cash flow accretive for us, and we are looking in for some inorganic growth opportunities in order to deploy this excess funds which we'll have in the company.
And let's also talk a little bit more about your CapEx plans. You have planned cumulative CapEx at Glithor and Mambatu, which is about 160 odd crores. Any other CapEx plans that you have, and will these CapEx plans then impact your deleveraging strategy that you just spoke about?
Yes, so these are the two CapEx plans which we have highlighted in our IPO, and the third one is the one which we are talking about putting up a plant in Gujarat. So these are the three CapEx plan right now, and we don't need any debt. We don't need to raise any debt to do any of the three expansions. So that as it is, will deleverage the company, and we are generating cash flows. So I don't see any major challenge. Rather now, we have a very unique challenge of deploying this excess cash and putting it into business further for its momentum, for its growth momentum. So idea is for the company is to grow inorganically as well, and to develop some value-added products in the sandwich panel category.
Okay, so that's as far as your expansion plans are concerned. Mr. Singhania, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the revenue growth and margin guidance is going forward. And remember, the management continues to remain very bullish. They are penciling in 25% plus top line growth over the next 3 to 5 years and 10.5 to 11.5% margin guidance. But on that note, we need to slip into a very short break. Commodity Central is coming up next.